Hello to a new series, the Commodity Super Cycle. Today, I'm super excited having Ole Hansen from Copenhagen, from the Saxo Bank, as a guest. Ole, how are you today?
I'm very well, thank you very much, Mark, and thank you for having me on the show.
Oh, it's my pleasure. I'm honored, actually. You're the head of commodity strategy at the Saxo Bank, and you are very a deep insider. So before we start, even if it will be published after the game happened, what's your prediction for the soccer game Denmark against England?
Well, it used to be it's always a game of two halves. In the end, Germany wins. This time around, obviously, it's going to be slightly different. So, well, you know how it is. I've obviously really drumming for the Danes. We've done exceptionally well. We saw what happened in the first game. I think it's just brought the country and the team together. So I think that there could be a surprise. But clearly, we at Wembley, we got 55,000 Brits basically longing for a victory after, what is it, 50 years, probably as old as me, since they won something last time. So it's an uphill struggle. I think being a Dane, coming from a small country, I think we're all very happy what we achieved so far. So if the Brits win, I'm not. I lived in the UK for 20 years, so it's my second home. So, but obviously, clearly looking for a Danish surprise tomorrow.
Yeah, I hope one of those underdogs will win the championship at all, and not Spain, not Italy again. So I hope it's Denmark, because the hearts are definitely with you guys, especially after the first game. And if it's England, it's okay as well. May the better team win. But hey, my audience will not know you so far, so please tell us something about you. Just a short introduction.
Well, as you say, I'm Danish. I have my background from the banking world for more years than I care to remember. But I spent, as I said, 20 years in London, where I was both in the futures business. I was broking into the London Futures Exchange back in those days, where we were screaming and shouting, losing our voice at the end of the day. Moving on to a hedge fund where we traded very actively in a variety of commodities, and also obviously stock markets and currency. So my background is really from a practical perspective. I returned to Denmark back in 2008, just a few months before the financial crisis. So just managed to get my foot in the door before everything froze up. And since then, I've just been slowly developing my focus on commodities, and that's really been the main thing for the past 10 years. So primarily focusing on the markets that our clients trade. So obviously, Saxo Bank is an online bank providing access to global markets. So we're primarily keeping an eye on the markets that our clients like, and these are the well-known gold, silver, copper, crude oil, some of the agricultural products, increasingly seeing farms becoming bigger and bigger, so their need to hedge their production or also expenses is growing. So that where I am today. So we write reports to our clients, which is published on our website and on our trading platform, quite actively on Twitter, which I find a great source of inspiration. So I like to give and take. And yeah, so that's basically it. Based in beautiful Copenhagen, where the summer has arrived. So it's all
finally
good.
yeah. So yeah, interesting. You said for 10 years now you're in the commodity sector. So the last 10 years, they were not easy for commodity guys. It wasn't fun, actually, being invested in commodities. Everyone was making money except the commodities investors. So but that the downtrend came to a sudden end over the past 12 months, and commodities have been exploding. So why do you think are commodities so cyclical, and what are the drivers for that?
Well, it's a combination of several things. I think just to wrap up the 10 years, as you mentioned, let's just look at the last 5 years. It had definitely been a period where we've seen more and more banks just basically vacating the space, because it's been a very difficult market to operate in, because we've just simply gone through a near half decade of ample supplies. Curve structure, which basically means if you are passive investors through ETFs, you're actually losing money on a monthly basis. A lot of that has changed, and really, obviously, the trigger was the low point last year as the pandemic really closed down the world in March and April. Yeah. We saw some initiatives triggering a reversal in some of the prices, and since then we've had at least up until recently what we can almost characterize as a synchronized growth in all the three sectors: agricultural, energy, and metals. The agricultural space has been driven by the worst drought in Brazil in 90 years, and also a massive amount of buying from China as they've been rebuilding their hog herd after the African swine fever back in 2018. Adding to that, obviously the lockdowns, which caused some dislocations in transportation, also having an impact on that sector. So we are now in the middle of the growing season here in the northern hemisphere, and much really hinges on the weather over the coming months to basically to see whether we're going to continue to see very elevated prices into the autumn and winter. The metal space is really strange or really interesting, and actually so is the energy market. We are based here in Europe, where there's so much focus on green transformation. But the craziest thing you can say is that investors already have moved on. They want to invest in ESG related products. They do not want to have any black fuel or metals on their books. They don't want to look at mining companies. The problem is we need a lot of raw materials to get to that decarbonization process, and that basically means we are potentially facing a period of mismatch between supply and demand. We're already seeing that to a certain extent right now in crude oil markets. That is somewhat being political motivated by OPEC Plus, keeping supplies tight. But we may end up in a situation where the lack of investment going into the finding of new raw materials over the coming few years could potentially send prices even higher. And I think that's those are really the key sources of driving these markets. I think also we have to. There's a very, very huge political will, not only in Europe, but also in Asia, and now also in the US after Biden won the election last year, because that's another trigger, because you can put in the 1st of November or the 5th of November, that's when Moderna came with their vaccine announcement. Since then, really, the global economy started to look towards improvement, and the market started to discount increased demand for raw materials. So that's really where we are now, and the reason for being bullish on commodities, even though we had a bit of a pause now, has most certainly not gone away. And because of the political will is there, it's also the question of, normally you would have the mechanics that a high price is the best cure for a high price, because it drives increased production and lower demand. But this time around, it may not. These mechanisms may not materialize. And when you at the same time have oil companies not really they want to build windmills instead of drilling for oil, then we need to see oil demand start to taper off, and that is just simply still a few years away before that happens.
Yeah, as you know, you are part of the series, the commodity super cycle. Do you think we are in a super cycle? Will we see a decade of commodities?
It's always difficult standing at the foot of a mountain and to try to see how high it is. But super cycle, as you say, is described by a period of up towards a decade where we have prices going in more or less in one direction. Yeah. It's difficult to. I think it's difficult to say at this point whether it is going to be like that, because we will potentially see demand starting to be impacted sooner or later, especially something like the energy, because the green transformation in that front is going really fast. But I would at least look 4 to 5 years out. The reason why metals is being brought up constantly is obviously the fact that while you as a farmer can use a good crop year and high revenues to plant more the next year and thereby increase supplies, it doesn't work like that in the mining business. It can easily take 5 to 10 years for new production to come online, and it is this period of mismatch between supply and demand that drives the super cycle and forces prices high enough to incentivize producers to really get their act together and start looking for more materials. So on that basis, I think we are looking at years. Whether it's going to be a decade, that obviously remains to be seen.
Yeah. Okay. So I'm on my side. I'm super bullish for commodities in next years. I think we definitely will see a super cycle, because we had a bear market for years actually. And also, if you look long term, it was pretty cheap last year around this time. The commodities area was super cheap. Gas, oil, uranium, everything actually. So, but where could things go wrong? What would be a bear case for commodities? What would you see for that?
That would first of all be China, I think. China still accounts for close to half of all the raw materials that's taken out the ground or produced. So if we do get we are seeing signs of a slowdown in China, but whether it's going to be having a major impact obviously remains to be seen. There are initiatives from the government trying to curb prices because they are seeing rising input costs, eventually also being passed on to consumers, and that's clearly not a situation they want to experience. At the same time, they were first out the door in terms of adding stimulus back into the market, and some of this stimulus is potentially starting to fade now, and that would basically show how strong the economy is to continue on the same trajectory, and that's probably where you start to get a little bit concerned. So I think that's probably the main risk. At the same time, the bullish nature we've seen in the market so far, to a certain extent, has been driven by market expectations. So basically, investors front running the expected pickup in demand. Because what we have to remember, if you are buying a stock, you can buy a stock in the anticipation of they will do something great within the next couple of years. Commodities doesn't really work that way. It's a spot product. So every day there's a supply and demand that needs to match. And if you are driving the spot price up to levels which is not justified by the available inventory, then inventories will be delivered into the spot, thereby sending the price back down again. So the spot price over time doesn't lie. So right now, potentially something like copper, we may have just seen the price just run a little bit too far ahead of it because investors been building up their positions. I think the same goes for something like uranium. I'm bullish uranium as well. I think we simply cannot get the kind of base load going forward without looking at nuclear, because we cannot rely on sun and wind to achieve that. But if you look at some of the ETFs, that primarily only invest in the underlying, invest in the raw material, invest in U3O8, and you look at the ETF track, because the companies obviously rally strongly in anticipation that they will get higher revenues from higher uranium prices, not jumping the gun too soon.
Yeah. So let's do a deep dive in commodities. You guys at Saxo Bank are one of the most respected commodity advisors in the world, actually. So we really want to get your opinion on many different commodities. So as many as possible, actually. So, but in general, as a whole, do you think commodities are still mostly undervalued, especially compared to other asset classes like stocks, equities?
I think they are. Historically, they're still looking quite cheap, even though the rally we've seen over the past year has been quite phenomenal. But it obviously shades a bit when you see how the market's been performing during that time. So yeah, I think there are definitely pockets of markets where you are relatively undervalued, and I think I can't stress enough as well from an investment perspective how important it is to have a market that is in what we call backwardation, basically where the spot price is the highest. It basically gives you a positive role when you are investing in ETFs, because you can look at some of these markets and performance over the past 5 years. They've been absolutely dismal, and that has really dissuaded a lot of investments coming into commodity, and that has started to change over the past 6 to 9 months. So that is a major change. So as long as we have markets where we got tightness, we also have a backwardated market which will give you a positive role yield that will attract macro-based investors into the market.
So what is the sentiment within your clients regarding to commodities?
Well, the sentiment is most certainly one of improved focus. I've had a much busier 6 months than previous years, which is quite natural. It is attracting a lot of media focus, a lot of headlines about multi-year highs being reached here and there. Investors coming in just want to check how can I get involved, how should I spread my risk, and so on. So yes, we are seeing a quite a substantial pickup, and also I think and again, we haven't talked about that yet, but the whole prospect of inflation or not inflation, that is also playing its part, because you can buy an inflation protected bond, or you can buy commodities which historically have proven to keep their value during times of rising inflation, and that is the added perspective. So actually, just replying just to your previous question about what could go wrong. Well, what can go wrong is if inflation doesn't just basically peak and would start to turn lower. That could see quite a few of these reflation trades exit the market, and that could obviously in the short term put the market under some pressure, but that will just take it, then that means we'll just start to refocus just on supply and demand, which still looks like it's going to be supportive.
Okay, so yeah, let's talk about inflation, because it's picking up everywhere in the Eurozone. We had 2.5% in May, 2.3% in June. We had 5%, nearly 5% in the US CPI. So the central banks came out and said, hey, don't worry, it's just transitory. It won't stay here for a long time. So what's your take on this?
Well, I would obviously hope that they're right, because no one wants to. No one would like to live through a prolonged period of high inflation. I mean, you probably almost have to be as old as me, and no offense, but you're probably also not quite at my age yet. But you have to be up there somewhere to actually have experienced interest rates of your parents taking out a loan, paying more than 20%, and inflation just eating out your eating away of your income. So I don't want to see it, but at the same time, just looking at how the world is behaving right now, the input costs are going up. We're seeing these phenomenal freight rates. We're seeing logistical issues. We've seen bottlenecks. The question is obviously how many of these will continue to will become of a bit of a more long-term nature. But I struggle to see that we are not going to see a prolonged period of inflation, and potentially also even low growth, because even though all the decarbonization and investments going into a greener future, even though that will create some activity, it will also be punitively expensive and potentially have a negative impact on the overall level of growth. So lower growth and potentially higher price pressures, which is clearly not a good cocktail.
Do you see any chance for deflationary bust?
I don't think so, because the question is obviously how much what happens when all the stimulus start to be weaned off, whether whether economies can stand on their own feet. I think they probably can. So I hope let's put it this way. I hope not. But a low growth, lower than expected growth environment. But I don't think deflation. I sincerely hope not.
Would your mind change if there would be another hard lockdown in autumn, fall, winter?
That will have an impact, and we can. I think that, and that's probably one that none really are taking into account, because we are get the vaccine rollouts very fast now across parts of the world. But then again, we also have some of these variants proving not to be, or some proving to be somewhat resistant to these vaccines. So we're not out of the woods yet, and that potentially could be something that could have an impact, especially I would say probably on because we're not gonna go away from the green transformation theme, but potentially something like fuel demand could take a hit, or long haul flights, which basically means that they expect recovery in fuel demand may not be as strong, and thereby we may find oil price at least temporarily at too high levels.
Okay, so let's talk about agriculture. They have been on a tear for the last couple of months. So what do you make out of the current price action, and what's your outlook for agricultures?
Well, I would say if you want to predict agriculture, you have to have a direct line to the guy who delivers the rain from above. I don't have the direct line, so it's always guesswork, and there's no doubt there's a reason why floor traders in Chicago in the old days slept with their feet out the window just to sense if there's any weather change coming overnight to determine the price action the following day. But what we can see obviously is that we got weather developments becoming more volatile across the world. It's we see hotter weather, colder weather. Just this week we had frost in parts of Brazil, where they haven't had frost for decades this time of year. At the same time, we have this heat dome. We had heat dome in California and Canada, killing hundreds of people and basically scorching some of the land there. So we are entering into a more volatile period in terms of agricultural production, and that will, I think, keep the market under some pressure. We just saw last week a report from the US where the market had basically been expecting that the US farmers would really grab this opportunity to plant as much as possible. That did not turn out to be the case, especially for something like corn. And that basically leaves the market pretty tight as we move into the autumn. So we don't need many missteps in order for this market to remain elevated, prices to remain elevated into the winter and into next year, and as we approach the next harvest in South America.
Yeah. So if agriculture prices go up and keep rising too much, actually, we all know this will have severe consequences all over the world. Last time we saw the Arabic Spring, for example, when bread prices in Egypt just skyrocketed. So are you worried about that for the coming years?
For now, I'm not, because two of the agricultures that hasn't really done too much in terms of upside moves is something like rice and wheat. And these are really the two main staples for the bulk of the global consumers. Wheat, obviously, in North Africa and Middle East, Europe, and rice in Asia. And as long as we don't see any substantial pickup there, then I'm not too worried. The good thing about wheat is it's a more globally produced market. Corn is very dependent on the U.S. and South America. Same goes for soybeans, but wheat is both in Europe, Germany, France, Russia, Ukraine, Denmark, obviously a small part, but and then also in the US. So it's a bit more spread out, and therefore also a little bit less exposed to a shortfall. So for now, I'm optimistic that that at least that front can be averted. But at the same time, fuel costs are going up, and we're seeing right now is places like India where they're really starting to feel the pinch, because what happened during these years of low oil prices, that several countries took the opportunity to reduce some or maybe even adding surcharges on fuel, and now that the import cost is going up, then suddenly the consumer price is pretty elevated. So it will have an impact on consumer spending. But at the end of the day, we can live without oil, but we cannot live without breads and water. So that's the main thing.
Yeah. So talking about energy and fuel costs and everything, let's switch gears to energy. A year ago, oil fall below zero. It was crazy. It was definitely crazy. I think we were at minus $35. Since then, there was only one way up. So what's your outlook for oil? And do you agree with a lot of people out there who hope we will get rid of fossil fuels, or will we see crazy oil price jumps during this decade?
I think the getting rid of fossil fuel is the reason why we are likely to see higher than expected prices over the next 5 years. Because, as I said as well, investors have moved on. Many of the large investors are not allowed to invest in oil companies and mining companies anymore, and that basically leaves OPEC plus in the driving seat.
Yeah.
Or countries producing where it's mostly controlled or managed by the government instead of elsewhere where it's individual companies, especially some place like the US. So we've seen that already. U.S. production currently stuck around 11 million barrels, peaking at 13 before the pandemic broke out. Now we got prices at the highest level since 2018, and nothing is happening. I think that will obviously not continue like this. We will see a pickup in U.S. production, because there are also independent producers who will, where the temptation to increase is just simply too great, because the margins are probably the best they've been for a while. But we have to remember, shale oil producers, they have to hedge a certain part of their production, because a lot of the production is based on debt, borrowed money, and the banks basically need proof that they are making money. So they have to go into the forward market and sell futures to hedge themselves. And what we're seeing right now, because of this very backwardated market, as we call it, where the spot price is the highest, while OPEC are selling at spot levels in the 70s, approaching 80, U.S. hedges looking at the second half of next year, they're selling some close to $10 below that level, and that is obviously a competitive advantage for OPEC at this stage. So we will see U.S. production pick up, but I think it really all depends on where we are going to see the eventual peak in global demand. Are we going to return to and exceed the peak we had before the pandemic, or are we already now slowly starting to see the impact of the electrification in the number of cars and so on that will reduce the demand? I think also another one that may may slow down the growth in demand is air travel. I think we're seeing a big pickup in regional travel. Here in Europe, we are now allowed to more or less to travel wherever we want to. That obviously will increase flight demand for flights, but intercontinental, I think, is something else. People are still hesitant about moving to other regions for fear of picking something up and bringing it back home. So we're potentially seeing a slower return to full demand, but at the same time, supply is also going to be an issue. Not now, because right now it's a lot of the rally we have seen since the low point last year has been politically driven, because OPEC Plus has managed to cut production and keep it tight all the way up, and thereby supporting increased prices. They're currently sitting on 5 to 6 million barrels of additional oil that can be unleashed back into the market. That will happen over the coming months, and so the big question is really what happens then? Will we see a pickup in the U.S. production strong enough to cater for the additional barrels that's required after that, or are we going to run into a period of shortfalls? And that's really what potentially could drive the oil price back towards $100.
Yeah, very exciting times. Yeah, we will see. So what do you make of everybody's darling in Germany, uranium, nuclear power? What's your take on this?
Well, I think it's as I mentioned, I think it's something we cannot avoid. And I think also back in April there was a report sent to the EU, basically where I think they concluded that uranium should be considered on par with alternative energies, greener energies. And that if that gets ratified, if that becomes the European standard, then obviously uranium has a future in Europe after being neglected for a number of years. I think the industry has moved on, has developed. The security is much bigger now than it was in the past. So, but it takes time. Just like a mining operation, a nuclear power plant takes years to build. So that basically means that we are. It's just it's all a bit question about the timing. I know that there are some really there are many investors looking at uranium as the next Bitcoin. The problem is it will rally when the revenues also justifies a rally in these companies' stock prices, and so far we're simply not seeing that pick up in the price for uranium, and that will probably take time. But I think we're seeing a lot of plants being rolled out in Asia. That's the main growth area right now. If Europe joins as well, and if we get some signals from the Biden administration, then obviously the market will try to preempt the pickup in both prices and earnings for many of these companies.
Yeah, and if we have to achieve the goals from the Paris Treaty, we need nuclear power actually, because we can do it with coal or with gas. So yeah, we will see, I think, a big renaissance of nuclear power in the future. It was also a whole chapter in my new book. So I also think, in my opinion, the green revolution is actually a commodity revolution. The amount of required materials for those so-called sustainable products is insane. So what are your thoughts on this?
Absolutely, and if we need to get to where we want to go, where we need to go, then we are looking at copper, aluminium, tin, nickel, silver, platinum, cobalt, some of the rare earths. These are all part of this transformation, and some of them are in good supply. Some of them are potentially going to go into short supply, and that is the key source of demand, and therefore also the reason why there is a risk that we need to see higher prices, really, in order to incentivize mining companies, because they are running a little bit scared, because they just, as we talked about at the beginning, we come through a 5-10 year period where if we just break it into a longer period, we had the 2000 to 2008 where we had the massive demand from China. It led to a massive increase in prices. Mining companies, oil companies, they all beefed up their operation to cater for that increased growth. Suddenly we plateaued, and we were left with a market where the production was basically too high into relative to demand. and that left in that sideways trading formation now for a number of years, and companies cut back their capex in the meantime, and that's where we're standing right now. And if we are seeing a pickup, which we believe we will, then that's really what's going to drive the next stage higher for many of these metals.
Yeah, definitely. So without base metals, without commodities, there won't be a green revolution. There won't be artificial intelligence, no smartphone, no electric car, nothing. And most people underestimate it or don't even know it. So that's why we have to educate them. That's why you're here, actually.
Exactly. And I think also that we just see now, we saw the new orders in Germany surprised to the downside because their car sales was troubled. And it's the whole lack of microchips. We're lacking. So it's not only just big bulky commodities like steel and copper. It's also commodities that goes into building microchips, because there's a lot of technology involved in these processes.
Exactly.
And that's also everything starts somewhere, and then most of the time that it starts with a product that has to come out of the ground.
Yeah. So while most of the commodities went up in price enormous in the last couple of months, gold didn't move at all. Actually, since August, we are in a little bear market. We reached a new all-time high in August 2020. Since then, nothing happened. So is gold right now the most undervalued commodity out there?
I would almost like to say yes, but at the same time, it's what we have to remember with gold is it is the most interest rate and dollar sensitive commodity, because it is an investment metal. So it takes a lot of its inspiration, trading inspiration from what happens to the dollar. If the dollar goes up, gold tends to suffer. If interest rates goes up, gold tends to suffer as well, because the alternative is giving you a higher reward than sitting on the metal that doesn't pay you any coupon or dividend. So I think that's from the outside what we have to remember, and that's really also the reason why we have seen gold underperform, especially since January, when interest rates suddenly started to move higher in the US as inflation and the reflation trade started to really to pick up. What we need in order for gold to move higher here is first of all a dollar that stabilizes and potentially starts to weaken. I think that is still the direction I think could offer the least resistance over time. And then also what's happened to interest rates. And what we have to remember when you look at yields on bonds, you have to break it down in the two underlying components. You have the nominal yield, but that nominal yield is basically derived from the inflation expectations for that period, and that minus the nominal yield, you didn't get the real yield. And if inflation is higher than the nominal yield, then you have a negative real yield. That's the situation we have in the US right now, where the real yield on the 10-year basis is around 90 basis points minus. If we see a rise in nominal yields, which I think people are still worried about, we will see, because eventually we will start to move towards some kind of taper, then nominal yields can go up. But at the same time, if we are right in our expectation that inflation will potentially go up almost to the tune of what nominal yields goes up, then we don't really have any negative impact from real yields staying more or less at these lower levels. And I saw a report today just from Goldman Sachs basically saying the recent correction in gold from 19 plus back down below 1700 was really not justified if you look at the movements in real yields. And they're saying at current levels, gold market is pricing in a real yield around negative 10 basis points, and we are actually at minus 90. So with that in mind, I think gold, just looking at that, is at least in the short term seems to be undervalued. And if it's undervalued, then other metals, something like silver, potentially could be doing even better, because it's got the input from the industrial metals as well.
Yeah. So do you have at the Saxo Bank any price targets for gold, silver, platinum?
I have a gold silver ratio of silver ounces to 1 ounce of gold. I think I could easily see that move down to the low 60s, potentially a little bit lower. That signals 10% outperformance of relative outperformance of silver. But I think we most certainly still in the situation where we could see gold return to the 2000 level. Yeah. I think it does tie in with the expectations, or it needs a change in the expectations expectations for inflation and where central banks are seeing inflation going. And for that to happen, we probably need to be a bit patient and move into the autumn before we start to see additional data pointing towards this inflation, but perhaps not being as transitory as we are led to believe. I think furthermore as well, we had a dismal first quarter in terms of central bank demand. That has now started to pick up. The World Gold Council just released numbers which does indicate that central banks are back in the buying seat during the second quarter, and if extended into the third, then that would provide an underlying layer of support as well.
Okay. Yeah, let's talk about investing. So what do you actually recommend your clients, and how should they invest into commodities?
I think it really depends on if you have a specific view on any of these individual sectors, or whether you just want to be part of the so-called super cycle. When it comes to that, that's what I prefer, because again, if you're not an active trader, you have to respect these commodities, individual ones, because the volatility can be quite great. If you are a regular Bitcoin trader, you don't mind market moving up 10% while you're having your coffee, or down as well. But regularly investor, I think, who are normal trading stocks, they just have to be either very risk focused or just spread out their investment. So I think when it comes to that, there are several ETFs which can provide you that exposure. What you need just to be aware when you look at an ETF, you need to just to check what the underlying index is, because there are different indices. If you look at the three big ones, there's one called S&P GSCI Commodity Index. That is very heavily exposed to the energy sector. Then you've got the Bloomberg Commodity Index, which is more trying to adapt the 1/3 exposure to the all three sectors. And then you have I think you also have one which is Deutsche Bank's Invesco Deutsche Bank, also very heavily in energy. So it depends on if you are more if you want to even them out a bit, then you should look at more of a broad exposure. But if it's energy you like, then there are others that could provide a better potential upside.
If you could invest in just one commodity, what would you choose?
I would probably choose silver, because I believe that we are facing a prolonged period of rising costs, high inflation. I believe growth is not going to be strong enough for central banks really to go aggressively the other way in terms of raising rates. That leaves the market exposed to high inflation, low real yields. Silver has the additional high exposure to the industrial metals. Silver is part of the solar panel revolution. And just from looking at the chart as well, we are trading below 30. We peaked at 50 back in 2011. So it's a little bit easier to predict or see a potentially higher price for silver compared to gold, which already is sitting not that far away from its record high. So that's probably the one. I know maybe not as sexy as if I went for lumber or something, some of the others that has doubled in price in a short period of time. But I'd also like to be able to sleep at night.
Exactly. It's a very good pick, Ole. Don't worry. People will like it. So last but not least, let's do some rapid fire questions and answers. Gold or Bitcoin?
Oh, you got me there. I have to say gold, purely simply from the fact that it's not because that I don't like Bitcoin. I just don't understand it. I don't understand the Bitcoins as a store value. When you have volatility like you've seen this year, if you are a family office, you're employed to preserve your family's wealth, and you see markets move 20, 30, 40%. That makes me nervous. So on that basis, and if you're a longer term investor, I prefer gold, but I'm potentially obviously at risk of losing out big time.
Yeah. But, you don't get nervous if it went up before 200% or something. Then you're very chilled, actually. So
exactly,
it depends when you invested.
Exactly, and that's another thing. The timing in some of these cryptos is obviously paramount important. The risk of getting caught out on the top, and then you see a 10-20% correction. have you got the ability to withstand that before it eventually potentially move way back above where you got in? So yeah, the entry level is pick your timing. That's crucially important.
The interesting thing is about Bitcoin, it's moving in a 4-year cycle. So even if you buy it at any low in the past, at any high in the past, you have to wait 4 years and then you are in the plus again. So for now, it worked the last couple of years. We will see if it works in the future as well. But anyhow,
so I think, so I think on that basis, I think the key takeaway is basically just don't apply too much leverage.
Exactly.
That is probably that's how you can sleep at. That's how you can sleep at night as well.
Exactly. Diversify. When I started recommending Bitcoin, I said 1% of your net worth, and if something goes wrong, you're not bankrupt. You don't have to live under a bridge in Copenhagen. Yeah, you still have a house and have some money left. So yeah, it depends. You need always a diversified portfolio with any asset class. Actually, don't overdo it. Don't get over leveraged. It's always very, very risky if you have like 90% in silver or tin or whatever. Yeah. So what do you think? Will a fiat currency still be the world reserve currency in 2031, in 10 years?
Yes.
Okay.
I think we're not there yet. I know we are going to be more and more digitalized. I mean, I can't remember when I last used a coin in I had a coin in my pocket. Obviously, that's even though you're using an electronic payment, then that's still the fiat currency. But obviously, we are moving much more electronically, and that basically means that there is a room for something to develop in that sense. But I would say 10 years out, no.
Okay, good. What was the most important book you read so far?
Oh, I think probably it's the old book. I can't now. It's very embarrassing. I can't remember the author, but he's very famous. It's very famous. Now the price of oil. Sorry, the price of oil, which was came out 20 odd years ago, because it really got me interested in the commodity space. Just recently, there's been a book by the two Bloomberg journalists just taking you through the development of the commodity market. That one was actually also quite a fascinating read. So, but I think the one that, because it got me interested, and just realizing that this market is so much more. To sense a much more, well, it's independent of what's happening elsewhere, and then there's always something going on. I can see that on a daily basis when we do market quick take in the morning. We do podcasts on a daily basis. I always have a story to tell, because there's always something going on.
Never gets boring.
Which is independent from all your macro data and what have you.
Definitely, true story. So, if Denmark wins the European Championship again, what will you do? What will Ole Hansen do in Copenhagen? Will you dance naked, or I don't know what's going on?
Well, I will be on a harbor on a Greek island, so at least it will be a little bit warmer to jump in the water there. But I'm sure it's going to be great fun. The Greeks are lovely people and very friendly to the Danes. So I think it will be a great celebration, and just very humble. In probably somewhat disbelief what this team has managed to achieve in such a short period of time.
Yeah, I will definitely cross my fingers for the Danish team. So we will see who will win. So last question. It has nothing to do with finance, with commodities, or with money. It's something personal, perhaps more. It will surprise you. So what is the meaning of life for Ole Hansen?
The meaning of life is actually just to get out of bed in the morning and feel happy about what you do, happy about your surroundings, happy about where you are, your place on this little wonderful planet. Not trying to look for something you cannot achieve and cannot get. Be happy with what you got. Enjoy your family and your friends. Small things, and just get the vaccine shots so we can hopefully get our life slightly more back to normal.
Yeah, and meaningful life is as well talking to people all over the world, like I did with you right now, and people will know you and will see what you do. So I will definitely put your Twitter handle in the show notes. I can recommend the podcast you're doing at Saxo Bank, and I hope to speak to you again. Ole, thank you very much. Tak.
Thanks very much, Mark. Best of luck with your series.
Thanks.